Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss FX carry, value and momentum over 200 years.
Hello everyone, my name is Radovan Vojtko and I'm Head of Research and CEO at Quantpedia. Today we will discuss three basic FX strategies. It's FX carry, currency momentum and currency value. But we will take a look at those strategies over the 200-year history. So we will revisit and review those strategies from very long time frame. Why we can do it? The reason for that is because there is a new research paper written by Joseph Chen that has a data for such a long history. I mean, it's a very good paper. I really recommend you to check out it when you trade or invest in the currency market. Firstly, what is the FX carry? I mean, the FX carry is simple strategy where you go long currencies with a high interest rate and you go short currencies with low interest rate. If you're interested to read more about the FX carry, we have an independent web page on Quantpedia that's related to this strategy. What is the currency momentum? In the currency momentum, you go long the currencies with the high performance and you short currencies with low performance. And what is the currency value? In the currency value, you go long the currencies that are relatively undervalued to their peers, and you go short currencies that are relatively overvalued compared to the peers, based usually on the purchasing power parity or some long-term price action like 5 years moving average. Let's get back to paper. Joseph Chen did the analysis of those three currency strategies and trading styles. What are the results? The results can be very nicely reviewed in a chart. First, we have a chart number of the currencies that were used in the test. What is the most interesting part for me is that even in 18th or 19th century, there are a lot of the currencies that can be used to trade. Then he ran the back test on cumulative returns of the carry trade. What is very interesting is that there is significantly positive performance in 18th, 19th and also in the 20th century, so the carry trade strategy is really robust. What is also interesting takeaway is that FX carry exists even during the periods when there are fixed exchange rate regimes. Especially interesting in this is that the carry trade has the highest performance during the time when there are fixed exchange rate regimes. The FX carry is not dependent on the end of the Bretton Woods or is not dependent on the floating rates among the currencies, but I mean it works very well also when some of the currencies are pegged or have a fixed exchange rate against each other. That's a very interesting result. Now let's continue. So another strategy that was backtested, that's not one of the three that we mentioned, is term spread or slope trade. It was backtested on the short rates and also on the long rates. As we can see, it has significantly positive performance over those 200 years. Then there was a test of the cumulative return of the dollar carry trade. So the dollar carry trade is a little different from the classical carry trade in which you trade currencies cross-sectionally. In a dollar carry trade, you just go long currencies or short against the dollar. It's a little different strategy, but it has also the positive performance of 200 years. Even that during the beginning of the 20th century and at the end of the 19th century, it had a flat performance. And then we have the currency momentum. What we can see is that the currency momentum didn't perform very well in the 19th century, and it started to perform well from the 1920s. The currency momentum is dependent on the independent movements of the underlying currencies. So the currencies cannot be pegged. They cannot have the fixed rate between each other. I mean, which was usually during the 18th and 19th century or at the beginning of the 20th century. So the currency momentum needs floating exchange rates among the currencies. That's the difference between the currency momentum and the FX carry. And we can draw something out of that. So when we have the more currencies that are pegged to each other, the momentum doesn't work very well. But when there are strong movements and the currencies are not pegged to each other, the FX momentum works very well. And the last result is related to cumulative returns of currency value or currency reversal. And as we can see, I mean, that strategy is probably not the strongest one. It had flat or negative performance for most of the period from 1980s until 1980. Currency value is performing only from 1980s onward. I would say that probably currency value is not the most significant strategy out of all of that. I would say that the most significant strategy is the FX carry trade, which works very well, and then probably currency momentum. I really recommend you to go and read the original paper. I mean, it's full of interesting ideas. I mean, everybody who loves the history and everybody who is interested in investing in currency markets should really read this paper because it will give you like broader perspective on the underlying forces that are important for the performance of the all of trading styles that are used in a currency market. So really go and read the paper. I would like to thank you for your attention. I hope that you will join me in the next video when we will once again review some interesting academic paper. I hope that I will be able to show you that academic papers are not boring, but you can find a lot of the interesting ideas and a lot of the insights in the academic research. If you like the video, please give us the like and do not forget to subscribe to our channel. Thank you.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.